Good morning, 8:25 a.m. Pacific Standard Time. The date 1/4/2015. So the holidays are over and the markets have some trouble here lately, and we're going to talk about that right now in this daily chart. So on the S&P 500, what we have here is a topping pattern from the Christmas and New Year's light volume, extremely light volume. We rolled up here and we made a high up there. Recently was 2072. So calendar 2015 January here has already started out with the seller program, and we did that last year in January of 14. These markets are overbought. There's going to be a good sized pullback coming. We had our first pullback that we told everyone, and that was a 200-point drop right over here. And basically, this day where we called that top, it started going down on 9/19, but as we went through October, we hit a bottom down here on 10/16. So that is our low. And from that point on a daily chart, you can see how narrow range this rally back up to these highs were. That means that people were on vacation. We had a big, super good pullback, and then they came right back in and made another high on this daily chart with the S&P 500 at an extreme overbought level. The last trading calendar day of the year, which would have been December 31, basically they took a lot of profits and ran for the door. That's exactly what they did. One thing I want to point out here is that the 20-day simple moving average is at 2052.8. The 10-day simple moving average, which is still pointing upward, means that this current trend is very strong. Another thing that we're going to have is the quarterly earnings reports. That's going to be starting once again. The 50-day simple moving average is going to be the key. That's going to be 2037.6. Down there at the lower line right here, that is exactly this line right here. I'm going to put it back up there now. That is in 100-day simple moving average. And we got extremely overbought again, and I just want to update the fact that when we got oversold here, because we did, short term, big bounce, we had a 200 drop down in the S&P to 1820, and they came running back, believe it or not, right below that 2100 area on the S&P. Now is January. It's a brand new year. There's going to be some more profit taking. These indexes are not done selling off. I just want to point out, though, on the daily chart to everyone, this is the part that I really want to emphasize on. Of course, the trend is extremely bullish. There's no doubt. This was a narrow range top. We call it a seasonality trade. Holiday was in. This is sitting on the 20 and the 40-day simple moving average. So basically, the core support will be right around 20.21. And we break down where we had this rally here. This was roughly at, let's just take a look. That was 20.72. And you can see that we broke through it. We went down through it. The red line is a 20-day. The blue line is a 40-day. So basically, now that everyone's going to be returning and they're back off vacation, we're going to see what the commitment is, because no matter what, this particular level up here, this is a good sized reversal bar. This is a very narrow range, non-committed people. They were not committed to buying it. They weren't committed to selling it. Okay, and the trend is extremely still strong. However, we are going to go down, and we are going to have a pretty decent pullback, and then at that point we're going to see if people want to jump back in the S&P, the people who sat on the sideline. I have a weekly chart, which is very, very, very important. And these are weekly bars. So you can clearly see right over here when we had that correction, 200-point drop, they came right back in and raced right back up there and made another super high in the S&P 500. I'm going to zoom in this piece right here. This blue line is our 10-week simple moving average, and we happen to be testing that at 2051. That's this line. That's the 20-week versus the daily moving averages. So the 20-week moving averages are considerably a lot more at the support level. This was that extreme volatility. Just want everyone to know that we will come down and we will test 2010.99. The other thing that I'm going to be looking at over here is we are at a critical level with the earnings season starting. So if we break below here, this is going to be that support level right here on this weekly chart. Yes, they came right in off of that bottom. The money on the sideline had returned to the market. We still see that trade is going to happen. One of the things I want people to know, though, U.S. fund managers are going to be looking at Russia, they're going to be looking at Europe, and they're going to be looking at markets that are beaten down. And Italy over there, they're going to start this QE1 with them. We already went through that for 6 years into this rally. So we're going to have the emerging markets and countries trying to catch up with the U.S. Money managers are going to take a breath. They're going to take a time out here in our U.S. markets, and they're going to be looking how they're going to buy beaten down Europe and beaten down Russia. Chinese, they didn't do all that well in their economic data. But this is where U.S. fund managers are going to look at buying the beaten up one, and it's going to be a hedge. But here's the deal. They could leave the market here in the U.S. and go buy up. We will find out. And we will come down here, and we're going to test these moving averages. I just want everyone to know that the 100-day moving average, that's this line way down here. That's 1,806. The 50-day moving average versus the 50 weekly moving average. You got your dailies, because I got the dailies behind here, and we're talking about both of them right here. So that's 2037 there on a daily, and it's 1939 on a 50-week. So we're looking at the combined simple moving averages as to where the market is going to get a support level. Earnings season is starting right now. One of the things that we're going to say and monitor very carefully is that rising 10-week, and you have a 20-week. And I've already given that number. So the 10-week is 2051 versus the daily 50 simple moving averages at 2037. So put your seatbelts on. This is a new year. I'm also calling for an extreme volatile year, meaning that these markets are going to have the long side and they're going to have the short side. And people are not prepared for volatility. Basically, the market just can't keep moving up in one direction. I'm sorry. There's got to be a round-trip trade. There's got to be a pullback, and there's got to be a long. That's what we're saying. Because we went parabolically up to the top. So this is the weekly 10-week moving average. I'm going to conclude the S&P with the fact that the volatility in the indexes are going to increase a lot more. Here's your daily right here. That's your daily. And I'll just move this over here. This is the daily one right here. Little doji sitting on the 20 over here, the weekly. And we are going to be coming back down. Put your seatbelts on. The volatility for 2015 is here to stay. That means the bull and the bear are both going to get an equal opportunity with the buyers coming in and that S&P 500. There's 10 sectors in there. So, once again, Happy New Year to everyone. It's a Sunday. The time is 8:35. Wow, 1/4/2015. Put your seatbelts on for these markets. You're going to need them. And this volatility is going to increase. At times it will be extremely high, and at other times it will be medium type volatility, but put your seatbelts on. You're going to need it.